on Good Morning America, and she's going to talk a little bit about what's going on with that.
Okay, I just have to say, I've just got to throw my bias out here. I totally like her. I mean,
Oh,
she's kind of no nonsense. You may or may not agree with everything she has to say, but I just really appreciate her no nonsense sort of approach to things. So let's
yeah.
see what she's got to say.
Let's see what she says. She's just another rich businesswoman.
Cost of buying a home right now. The average rate on a 30-year fixed rate mortgage is nearly 7.5%. That's up nearly 2 percentage points from this time last year. Here to talk about it, how it's impacting the housing market, none other than Barbara Corcoran from Shark Tank and the host of the podcast Business Unusual.
Thank you.
Love that name. Good morning to you. Let's get to the why. Why? Why is it so high?
Well, it's the only tool the federal government has for controlling inflation and getting a hold of our economy, and they've wanted to slow it down. And it's worked. A year ago, it was 9%. That was our inflation rate. Now it's down to 3%, and they're going to hold firm until it gets to exactly where they've targeted.
And the question is, how long is that going to last, and when will mortgage rates start coming back down?
Mortgage rates are coming back down. And will they come back down by enough for people to have an incentive to buy? Yes, they will.
How are these record high?
Oh, whoa, 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 whoa. She said some weird stuff there.
Okay, she said that they will come back down.
Well, eventually, yeah, they're peaked. Well, they're the highest they've been in 22 years.
Right.
And this,
So betting that it'll come down from the highest it's been.
well,
I
and
mean, it's lucky that it would, but
eventually, yeah. But that's hard to say when. Probably be another year. But the other thing about it is there's a couple things that are really shallow about what she said, and it's not a real good assessment. Is well, one, okay, so she talked about the Federal Reserve and monetary policy, and she said this is the only thing that the government can really, or that they can do, is raise the rates to get inflation down. Well, inflation was already going down before they started raising the rates. So this idea that she's given them credit for, well, yeah, it was 9 and now it's whatever, 3 and something. It's like, okay, well, yeah, but it was already coming down before they raised rates. So it's not clear that them raising the rates actually did much of anything. Right. Part of that's coming out of a pandemic. Now, what she said would make sense in a normal market, but we're not in a normal market coming out of a pandemic. We're in an abnormal market. So you can't say the same rules apply. Right? That's the huge mistake to make in finance, is once you start sitting there thinking, okay, the formula works even in an abnormal market. No, it doesn't. It doesn't. That's how you lose a ton of money. It's because you're so cohered to the formula that you don't look at the fact that, well, yeah, but those inputs aren't the same anymore. They're not working the way you want. So.
Well, I feel like when she said what she did, she was sort of dangling a carrot of hope to the American people, being like, oh, okay, they're going to come back down. Cool.
Well,
I'll just wait. Which, I mean, they will eventually probably come down, and
sure,
it
but
makes sense to wait for that. But I feel like my point is that the element of time is sort of a question mark in there. How long or short of a time that'll be.
Well, and then of course she said, okay, so this was 3 days ago. She said they're coming down, right? Well, you got to understand, what was it, 2 weeks ago? They were at 7.19. Now they're at 7.49. So she's wrong. They're not coming down. They're still going up. They could get to 8 for all we know.
Right.
So she was wrong about that. The other thing is there is another thing you can do, but it's not going to happen, right? To try and stem inflation, you could raise taxes on the wealthy. That would stem inflation quite a bit.
Oh, no, Duncan. We can't have the rich people pay more taxes. Whatever would they do?
Right. Well, but that means that she's now got to start paying more than the whatever 5 or 10% she pays in tax. She's going to have to start paying what everybody else pays, which means she'd be paying whatever an effective rate of 28%, which she doesn't want to do. But that's
Right.
but that's what but that would actually help stem inflation because what would it do? It would take her money out of the system. So it'd be less money in the system, which is how you stem inflation. So by raising the rates, what they're doing is they're making it harder to loan money, takes money out of the system, right? Liquid money, which is going to stem inflation because there's not as much to spend. Well, if you up taxes, it's going to take money out of the system, right? Because people have to pay more, which stems inflation. It's just a misunderstanding of how these things work. But she's sticking to with that. Well, the monetary policy is all we got, and I understand that. If I were worth $200 or $300 million, it'd be really tempting to say that, and not point out that the thing you could do that would really solve the inflation problem is tax me a lot of money. She's not gonna say that, but that's kind of what it is. What was the other thing I was gonna say? When she says the feds are gonna keep it up until they hit their target. Now that is true, but you got to remember the feds want to hit the target of 2% inflation, which we haven't been at forever. In fact, average inflation
So
is like,
that's their target. How much are they going to have to jack the rates up on us in order to get to that?
well, right, but that's the thing here is when you jack up the rates like that, who does it hurt? It hurts middle and lower income people. But that's the only, but from her perspective, that's the only policy that works is the one that hurts middle and lower income people, but
Yeah, so it's not her.
doesn't affect her in any way. And in fact, it's a good thing for her because right now, with as wealthy as she is, if she could go out and buy property, right, she won't get that 7.5% because how wealthy she is. She's secure, so she can buy these houses now that they're really cheap because demand is down because people can't afford the interest, right? And then when the interest rates go down next year, the prices of those homes is going to skyrocket
And then she can turn around and sell
and flip them for a lot of
and
money.
profit.
So there's a lot of advantages if you're wealthy, especially when they do these things with interest rates. There are disadvantages too, but the main thing is there are a lot of advantages if you know what you're doing. But the bottom line is you notice how she skirts past the real easy solution here to getting money out of the system is raising my taxes. If that's what you really wanted to do, but that's, the Republicans aren't going to do that in the House. But we could watch a little bit more of her.
High mortgage rates impacting the housing market.
The housing market is surprisingly strong. Everybody's surprised by it. Houses are not staying on the market. They all sell. 1/3 of them sell for over ask price, and there are just not enough houses to go around. So as a result of that, the housing market is as strong as ever, and it's so frustrating for buyers.
Yeah.
Well, but here's the thing: is it's not.
It's not.
It was. It was a month ago, 2 months ago, right? It was doing really well, but now it's starting to go down again. So
Listen, over here, it's not. It wasn't even strong across the board. Over here in New York, it's not been great.
no,
I happen to know realtors, and they call each other and say, "Anybody going to your open houses? Anybody going to your open houses?" Like, I mean, they're getting a little bit of people, but nowhere near where they had been before. So
yeah.
I think she's sort of trying to put some false hope into the system here. The system being into the eyes of the people. Oh yeah, great market. It's not.
Yeah. Well, and we can just to give you a sense of how big of an issue this is. So let's say we go back a year or two ago when it was about 4.5% was the interest rate. So it's 4.5% over 30 years. Let's say you bought a $400,000 house. That's about average, right?
Mm-hmm.
So your payment would be $24,000 a year on the house, so about $2,000 a month, a little over $2,000, and you would have paid a total of $736,600 or 700, so 737,000, right, on your $400,000 house. which means you would have paid $337,000 in interest. Okay? Take the same house at 7.5% interest, you'd be paying $33,000 a year, almost 34, right? 33.8 on the same house. So you're paying over almost $3,000 a month instead of $2, right? And your total, you'd have paid over $1 million for that $400,000 house. So to sit there and say, yeah, it's fine, it's all working out. No, it's not. She's full of shit. I mean, that's the difference. Is just, one is, okay, so I paid an extra $300,000 in interest, $370,000. The others, I paid $600,000 in interest. I paid more than the house the house was worth when I bought it. I mean, it's kind of interesting, but this is how, I mean, if you're rich, this is how you spin this shit.
Or a woman of the people, Barbara Corcoran. So we went to our viewers, and they are going to ask you questions. And this is one from Terry. She asked us on Facebook. She asked, do you feel houses will be more affordable in the future? It seems hard to find a house anymore that is going for the price it is worth.
There's not a lot out there, and Terry's having a hard time, and everybody is. But I can tell you this, house prices are not going to come down. I believe that when the real estate interest rates come down, when the mortgage rates come down, all hell's going to, oh, you're not supposed to say that.
Good morning, television. Not going to go on Shark Tank.
Okay. Every buyer on the sideline is going to jump into the market as long as the interest rates come down to 5 or 4%. And houses are going to go up in price all over again. I wouldn't be surprised if they go up by as much as 10 or 15% when that happens.
Oh, wow.
See, now, yeah, I agree. Yes and no. Right now, the prices are going down, though. We have seen that. Some drops. And part of that's because the interest rates are so high, there's no demand. So people.
Right. Here in New York, that's been an issue, and that's kind of the market I've been looking at the most, obviously, because it's where I reside right now.
Right.
But the buyers are super hesitant because the rates are so high, and they feel they can afford less. And as a result, places are sitting on the market for longer, and sellers are starting to lower their prices on the homes as a result. So that's essentially what's turning around and happening, honestly.
Right. Yeah. So I think she's a little off on this. I don't know, my camera went all blurry. All right. Hopefully that course corrects here in a second. But let's look at this.
I guess, are we going to go back to what she has to say more? Because I'm having some thoughts on this, but maybe she'll actually hit on them.
Yeah, we can go back. What did you want to say?
Well, she hasn't touched on it, but she's talking about the idea of buyers wanting to jump in when the prices go down, or when the rates go
down, right?
But what would also be reasonable to consider is if you are approved for an amount that's appropriate to what you want to buy, maybe one strategy would be not to wait for the rates to go down and to buy what you can now while the prices of the homes are what they are, with the understanding that when the rates go down, the home prices are probably going to get higher. And as a result, because more people will jump into the market, and at that point, maybe you refinance into a lower rate.
Right.
Of course, this means that you have to assess whether you would be capable of refinancing. You'd have to assess your own situation in that respect.
Right.
But my point being, there are more ways to do this.
Sure.
Than waiting on the sidelines if your finances are aligned in a way to where you actually can be purchasing now.
Yeah, but I think too the problem is that when you're looking at it, like I said, the big issue. Let's say you get the $400,000 house, right? You can't afford that because now you're paying almost $3,000 a month in a mortgage, right? Once you add your HOA and everything else, and your bills and utilities and all that stuff. Now all of a sudden you're looking at $4,000 a month plus for a house.
Well, my point being that only what I was talking about only works for somebody that has the wiggle room in their budget to be able to be approved for a sufficient amount of house at this higher interest rate.
Right, but
And
my
to be able to maintain that in their budget.
well, my point is, and we've gone over this many, many times. So 70% of Americans roughly make less than 75,000, right? So you've priced all these people out of the market because they can't even afford the monthly mortgage,
Right.
unless they get something really shitty that's really tiny. And even then, what's the point? You're not going to be able to flip it for much. So it's kind of a, it's kind of a pointless exercise at that point. But from her perspective, yeah, once again, from a rich person's perspective, yeah, now's not a bad time to buy and then flip it when it goes up 20% in 2 or 3 years when the rates come down. Because demand is shot back up. But you got to have money to do that. There we go. Finally. Focus. But yeah, I mean, I wanted to look at this. It's just a little Axios deal. Mortgage rates. It's 2001 levels, right? So this is back in December. August 11th. It's now August, 27th? So it was 7.16. So she's wrong. It didn't go down. It went up. Because it's 7.49 now. Or was 3 days ago. So, and that was the 22-year high. Let's go back to 2001 levels. When the housing market was really exploding, right? So I wanted to show you that graph real quick to show you that, yeah, I mean, this is a big jump from the pandemic. Because during the pandemic, no one was buying. And then when the pandemic ended, you had a bunch of people getting back to work and wanting to buy. Then it shot up, and then it went down again and leveled out. And now the rates are back up because the Fed is, once again, raised the rates, the federal funds rate, which affects all the loans, right? So if you guys don't know what the federal funds rate is, it's the amount a bank has to hold on to, the percentage. And it's a big deal because it determines what the rates are for interest. So like if Lacey's the Fed and I'm the bank, right? And Lacey says, well, the rate is 5%. Well, then I can loan $100 to somebody to buy a house or whatever, and I only have to keep $5 in deposit on that loan to secure it. But if she raises it to 10, like 10%, now all of a sudden I've got to keep $10. So I can only issue half the loans I used to be able to issue. Right? Or less than half. So there's a big difference there. And that's what raises the rates up quite a bit. So when they talk about the Fed raising rates, that's what they're doing. And it affects everybody. Because once you start talking about me loaning, $100 billion in houses, right? There's a difference between me having to hold $5 billion in deposits and me having to hold 10. That's a big difference. And how much I'm going to issue and at what price. So there's that. So that was just be wary. The house prices are going to be up, but the interest rates are going to be up. So, like, if you're buying a house, be wary. What am I going to be paying? And like Lacey said, check and make sure, can I refinance in a year or two? If I decide to do this, or if you decide to do this, you want to be able to refinance and get a 5% or 6% rate. And
this involves making a little more homework. If you're wanting to try to, work that sort of strategy, it could work out well for you if you're in a certain pool of people, but you do really have to plan to do your homework. Can I afford the payment while it's this high?
Right.
Can I get approved for a sufficient amount to be able to make the housing purchase that I need?
Mm-hmm.
And will I be able to refinance later? And you need to check within your individual situation and your finances to make sure all of those boxes can be checked before you can take advantage of this.
Right.
Now, if you can check all those boxes, you could make out pretty well. But you're right, Duncan, a lot of people really did get priced out just because they can't check all those boxes. They can't get a sufficient amount of house for the price they can get approved of. Their income level is in that 70 grand and below category, so everything got cut off for them.
Yeah.
So really it depends on, which little patch you're in here.
Right. And typically my advice when I talk to clients who are buying houses is what you need to figure is what do you want to spend every month on the house? And then work from there.
It's a very practical standpoint because we've talked budgets on this show before, and if you've got more than 50% of your income going to your fixed expenses, which is house plus a handful of other things. It's not only housing, but it's housing and a few other things that are fixed. And if you've got more than 50% going to fixed, you're not meeting your goals and your lifestyle's been shot all down the drain.
That's right.
So you really have to watch out for
Well, and you need to tack on too, that there's going to be repairs, damages, things like that. People don't always think about that. And then like a lot of times people buy the house and then they'll want to remodel parts of it. And it's like, you need to factor that in because a lot of them don't think about it. And then they get in there and they're like, well, I don't like the floors, so I want new floors. And I want, I need new appliances. Right. And they don't wait. And then the next thing you know, they're telling you at the end of the year they're broke because they spent $30,000 on extra crap for the house. Getting it repainted.
Now, in terms of repairs, I don't know if you've heard this, but there's a rule of thumb that I was taught with regards to maintenance and repairs on your house that you should at least budget in an extra, like 2% of what your housing costs were,
What, for the year?
Yeah. You should, add an extra 2% onto it to be setting aside because of the just repairs that are just automatically.
Right. I'm talking more about like when you first buy the house. A lot of people will.
That's a separate category. There's two things. There's what do I want to change about this home right now, but there's this sort of ongoing maintenance and repairs people do not think about. Is when somebody else deals with that.
Right. Well, for example, like I had a client. We just went through this where their air conditioning went out, so the whole HVAC heating cooling system had to be replaced. And it's a decent sized house, right? And she's going through it, and I'm telling her, you might as well spend the extra money and get the $30,000 unit with all the warranties and everything that's going to last you 20 years, right? And especially for this one, it was like a medical grade unit, so it actually filters bacteria and stuff out of the air, viruses and stuff. Comes with UV lights and all this stuff in the system to kill all that. And I was telling her, yeah, that makes sense, especially for an older woman. And I was like, but she's sitting there like 30 grand. I'm like, well, you could get the cheap one for 20,000, but then how many repairs are you going to have to do, and how long is that going to last before you got to get it repaired? And at your age, do you really want to be dealing with that shit? I mean, so, but that's the thing is it's like a lot of people don't think about that stuff, but it comes up. Well, anyway. If you're buying a house, good luck.